Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast. All right. I don't even remember how to start now.
Hello.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about the second annual, the Invested Dads official second half stock draft. Wow, that's a mouthful.
Woo! You can abbreviate that or something.
TID, second half stock draft.
Yes. So just recap last year. What happened? I forget.
I owed Josh a donut because he stumped me and the market in terms of his picks.
Yes. And again, as always, these are for fun. There's no real money involved.
Yes.
And it's not any sort of recommendation because you and I both picked our stocks off of guesses, hopes, and my whole thesis was recovery.
And mine was pandemic. Yeah.
You played more defensive, and it played out. So, again, as we're talking through this whole new second annual stock draft,
absolutely,
we're going to talk through some of our choices, not recommendations. We're not suggesting that anybody holds or invest in this. This is all fake money.
Yep.
6-month time frame, short time frame. So, again, not a recommendation.
And we also want to point out that this is not the way that we advise people to invest their money. Right. We do not advise people to invest their money for 6 months at a time.
Yep.
If you need your money in 6 months, that's not probably. These are definitely not things you should be investing in.
So this is just a for fun, picking names competition.
But in that light, we are so excited that this year you are going to be able to join us and keep track of your portfolio, your hypothetical portfolio, along with Josh and myself, along this 6-month competition. And there may be some prizes at the end of the year when this is over. So let's kind of get some rules out of the way, and then we're going to talk about our picks. Okay, Josh?
Yes.
So, rules. Up front, this is going to be taken care of through Investopedia. They have a game section where you can actually have this kind of thing go on. You can create a group, and other people can join your group, and then within that group, you compete with each other on the same set of rules for whatever time period you set. So we have chose 100,000 hypothetical
not real
United States dollars.
Yes.
Those are USD. And you're investing for 6 months, and you're competing with Josh and myself and other listeners. And we're going to be able to see everyone who's in. You'll be able to see it anytime when you're looking on the website there, once you're logged in. There is no margin, so you're not borrowing money to invest. There's no short...
you've already borrowed 100,000 of fake dollars.
It's 100,000 fake dollars. There's no short selling. There's no options. But where this is a little bit different than last year is that all stocks, mutual funds, and ETFs, essentially those 3 buckets, are fair game. So, knock yourself out. Do something crazy if you want. That's fun.
Yep.
You can join anytime after the official challenge starts on June 30th.
Yep. So, starting that morning, June 30th, you can log in to the Investopedia website, and we'll link that all in the show notes. It'll be there for you, or you could just Google it, and it's there. You'll have to set up your own little account, put a username and everything in there. Then you'll join our group. And then you could do this ahead of time, by the way.
You can create the account and join the group.
Everything's set up, ready to go. But you won't be able to place trades until 6:30. And then on 6:30 or later, you can start placing your trades in your portfolio.
Yes. So another thing to note is that you cannot reset your portfolio completely. So, like,
if you're doing really bad,
you can't just start over. So this is.
If I get negative 100,000.
Nope.
Well, I guess I can't.
You can't.
I'm not doing options.
No margin. No options. Yeah. So that is kind of where that sits there. Another couple housekeeping items. There are no hypothetical trading costs, which is actually pretty close to real life nowadays. And you may trade throughout that 6-month period. We likely won't do a ton of that. Yeah. We're generally pretty long-term investors, and last year when we did this, we stuck with our initial holdings and weightings, the whole time.
There were some we wanted to get rid of.
There was some we wanted to, and we didn't, so we have the ability to, and you do too. This isn't necessarily something that we want everyone spending hours and hours a day on.
But you can if you want.
But if you want, go for it. The max that you can put into a single holding initially, so on initial purchase, is 10%. So that means out of your $100,000, the maximum you can buy into a holding is $10,000. And that just allows us to make sure that everyone has some diversification in their portfolio, even 10 holdings at 10% is not very diversified. But
which we found out last year.
Oh, yeah. So you get some sort of diversification there. There's no maximum number of holdings. So Josh and I are holding different number of names and companies and things.
I'm going to buy one and hold the rest in cash.
No, exactly. And it's a 1% position. Yeah. But yeah, there's no maximum number of holdings. But like I said, there's a maximum weighting in one holding at the beginning, although that can increase over time.
Yeah, so if I buy something for 10% and it appreciates, I could end up holding something at a 20% weighting.
Yeah.
But my buy-in can be no more than 10%.
Yep.
Gotcha.
And you will trade on a 20-minute market delay in the software. That's just what's already set up there.
Built into there, and that will help reduce kind of trying to get little fractional. Since there are no trading costs and no taxes, someone theoretically, if they had all day long, could watch little price movements, buy and sell, and just slowly gain those all the way.
Yeah.
Which is not a very efficient use of time, in my opinion,
yeah.
for hypothetical money.
Yeah. So that is kind of the housekeeping items. When we get through our picks, we will then talk about how you can join and walk you through it step by step. But Josh, let's just dive in. We have very different approaches, I think, this year to how this was done. So as a reminder, last year, Josh and I each picked, we had $100,000, and we picked 10 holdings that were equally weighted at the beginning, and those were in 10 of the 11 sectors. And then we were stuck with those the entire time. And we counted total return for those 10 holdings at the end of the year, and that's how we were. This time, like I said, all of the other rules, you can hold a lot more. You can have different weightings. It's great. So 6/30 to 12/31, the entire second half of the year is what we will be measuring performance. And total account value really is how you're going to get your total return. So that's going to have all the dividends and everything included.
Dividends in there?
Yep,
okay.
Exactly. You're going to get quote-unquote cash, more cash or whatever, is how that will go. So this year, a lot different. I have quite a few different holdings in a unique way that I'm building this short-term portfolio. Josh has done the same, and we may have some overlap. We don't know. We actually haven't ran through these lists with each other yet.
Brand new.
So this is pretty fresh. So Josh, kind of get us started here. I know that you have a little bit less number of holdings, so you'll do one, I'll do a handful, and we'll kind of go back and forth.
We'll just walk through them.
And kind of give you what you're going to get a position in, and maybe just a sentence or two why.
Yep. And again, you'll find out as we go through, these are not investment options that we're suggesting should be held in real life. So one of my first ones, and one I didn't hold last year, is Activision Blizzard. They were two software gamings that merged together, Activision Blizzard. They have most notably the Call of Duty franchise, but ATVI is their ticker. And I thought, you know what? I like video games, and I'm going to own a video game company.
Sounds good. I'm going to get a couple of these.
Yep.
I'm going to call them my other bucket out of the way early. So as we mentioned last time, Josh and I literally hold 10 different company stocks. This time it's open to ETFs, mutual funds, whatever you want to do. I'm going to get a couple of wild cards out of the way, and I'm going to be taking some positions in the Grayscale Bitcoin Trust and the Grayscale Ethereum Trust. Not huge positions, but some exposure to that because I believe that they've both gotten beat up enough that it makes it compelling. And as far as a digital store value, I really believe Bitcoin's going to be only more widely accepted, as well as with the tailwind of El Salvador making it a form of currency now. That's kind of big. Help. And Ethereum is really kind of the blockchain future of the technological backbone of really the future of the internet. So I think that those are going to be some upside options for me there. Another, calling it my other bucket, is I'll be taking a decent position in the ARK Innovation ETF.
Okay. And
that's Cathie Wood's flagship product. She's kind of on the forefront of growth companies and growth investing, and her innovation ETF has been sold off pretty sharply as of late, and I think that makes it pretty attractive for a long-term holding. But big names in there are companies like Tesla, Teladoc, innovating, growing companies, but those have been out of favor, and that's made the ETF out of favor. So I think a decent-sized position in that is something I'm going to be holding a position in. And my final other category is ticker EDC. EDC is the Direxion Emerging Market Bull triple leveraged ETF.
Explain that real quick.
Okay, yes. So this is a triple leverage ETF for emerging markets. So essentially, it's going to be tracking an emerging market index of sorts. So emerging markets meaning developing economies. Ironically, China is the largest portion of emerging markets around the world, but there's also places like India and Africa and Latin America that are huge portions of that. But China's the biggest one. Triple leverage means that when the price goes up, you get 3 times the daily price return. When the price goes down, you get 3 times the daily price return. So it's very volatile typically, but I really believe that this is a way for me, without putting a huge portion of my portfolio in it, to get a lot of exposure to what I believe is going to be an area of the economy globally that's going to pick up some steam at the end of the year. The stock markets, and specifically EM, have not followed the fundamental story of China's reopening, really. And that's something that they're pretty much, not perfectly, but they're pretty much back to normal, and they have a huge economy, second biggest in the world and growing faster than ours. So I think that's why I'm doing that. So that's kind of an oddball pick. There's some wild cards in that bucket for me.
And just a reminder, again, a triple leverage ETF is a pretty volatile and pretty risky investment. So again, just disclaimer, that's not something, especially for long-term holding, that's not necessarily one for a highly volatile place that you want to make sure you're paying attention to that. So
yeah,
but for this type of event, it makes a lot of sense, because if you play well and it does well, you're getting 3 times that gain.
Or you can have a smaller position size to get the same amount of upside. Yep. However, so triple leverage, the way that these work is when it's going the direction that you've picked, and I've picked the bull side of it, meaning I'm getting 3% of the upside. You also get 3% of the downside, and 3% of the downside hurts more than 3% of the upside because of the starting point you're at there. It goes the other way if you pick like the 3 times bear. Yep. A lot of other ETFs track other indices with these same sort of situations, but very good disclaimer. Yep. Not necessarily something to be super excited about long-term money-wise, but hey,
for something like this, it makes total sense.
I lost so bad last year
that
got
a lot of comeback.
I'm pulling out all the stops.
All right,
Josh, what you got next?
This is actually a holding I had last time, and it's a holding I like, a company I like, just because I like to fly. It's Delta, and again, going off of that, thinking that they're going to possibly be seeing more and more flights going out. It should be better for them. And so I'm going to hold Delta.
Josh?
You have that too?
I'm going to own Delta too.
Nice.
I'm going to take not a giant position, but I'm going to own Delta and Southwest.
You're going to go both.
I'm going to pick both sides of the aisle because I recently had a trip where I flew Delta and I flew American. Delta by far provides the best experience. Yep. It's the cleanest and most nice. I like that, but I also see the family appeal to Southwest.
Oh, yeah.
And I think that
Free
families
luggage,
are wanting to get out, as well as people are going to be wanting to get out who aren't necessarily on the free luggage side of things flying Delta. So I'm covering both bases and going to be getting Delta and Southwest. What you got next?
All right, the next one is USD Partners, which is a railroad, and they do actually railroad for oil and a lot of the kind of energy stuff. And part of my choice for that was they just recently announced that the Keystone Pipeline has officially been canceled. And so for transportation of that type of equipment, they may see higher demand, and they're overall got beaten down a little bit, and there's still a lot of demand for energy.
Absolutely. So kind of building on the traveling theme, I have a lot of travel-related names in here. So
what do you got?
Next up, I will be taking a position in Boeing, which is a industrial company. Mm-hmm. However, it's an industrial company that is selling airplanes to airlines, and airlines are going to need a bunch of more airplanes because they're getting fired back up. Yep. So I really feel like, we were looking, Boeing was $400 and some, not, before all the crashes and everything happened and the MAX, but that the potential is still there, and it's trading about $250 right now. So I like the valuation of that, provided that they can get some big orders on those planes. I'm also taking positions in 2 rental car companies. One is Avis Budget, and I just rented a car from them and got robbed. It was so much money, but that's because they're making good money, and demand is high.
Cars right now.
So,
you know why?
Oh, because there's a shortage.
Well, they sold off a lot of their cars during the pandemic to help cover their flow. Now they're short on cars,
and they can't buy new ones
because they buy.
I know,
and so there's a higher cost.
So I'm taking a position in Avis, but I'm also taking a smaller position in Hertz.
The bankrupt company on its way back.
Hertz went bankrupt, and they're going to be coming out of bankruptcy at the end of June. And at the end of June, they're going to be kind of reforming themselves. So,
does Reddit have a fan? Are they?
They're not. I don't think Hertz is on there. Not yet.
Okay.
But I feel like I might be ahead of the game on that one. But I still think Hertz as a rental car company is going to be there. So that's those are my travel plays. What else you got?
You think if you get a flat tire in a Hertz rental car, it's a Hertz donut, like the old game used to do?
Yeah. So, that was on How I Met Your Mother. Marshall's brothers would be like, "Do you want a donut? There's this place in town called Hertz Donut."
Good times. All right. So here's a new one for me. Nautilus, which makes equipment for working out. So Bowflex, Schwinn, and then their own Nautilus brand, but bikes and treadmills and all that stuff. They saw a decent run up, but I don't think the trend for working out at home is going to change. I think a lot of people are realizing that that's the way to go, that there's cheaper and more easier to do. They also make some outdoor equipment as well. So that's where I'm going with that one. I'm going with people are going to be more in shape.
That would have been a good one to bring up in our recent Fitness Frenzy episode, where we talked about at-home fitness and how that changed in COVID. So we'll link that in the show notes too. That was an episode that we just put out a few weeks ago. Next category is oddball. So real estate as a sector, I believe, is running in the overbought sort of area of the market. It's really had a huge run over the last couple months. However, there's an area of the real estate sector that I think is going to continue to run hot, and that is real estate for hotels.
Ooh, okay.
Because of travel coming back. So travel coming back, I think, is going to be great. People have money. They want to travel and get out what they didn't do last year. 2 hotel REITs that I will be taking small positions in are Service Properties Trust and Summit Hotel Properties.
All right. I also have a REIT, but it's a more diversified. It's the Cohen & Steers REIT, and it's the ETF, the ICF is their ticker name. But Cohen & Steers is a fund company, and they specialize in REITs, and they do a very good job. So I did not have the confidence of Austin to pick, so I thought I'd just let them do their job. So I am going to own some real estate, but through an ETF that's diversified.
And that is a great way to get exposure to areas that you are unsure of. Yep. That's kind of the reason that I picked the ARC Innovation ETF is those are experts in growth and innovation, and they picked those for me, same way that you picked the experts in REITs there. You're sensing a theme here, but I'm picking another travel company here, Airbnb.
It's just because you got back from a trip. You're like all in on travel.
I saw how much money this stuff costs. So Airbnb is my next pick. I really think that people are ready to travel, and they really should be able to charge whatever they want, and people are going to pay it. Another couple bets on the consumer are a little bit different, but Polaris is one. That was one that took off last year as people wanted to get out and buy four-wheelers and side-by-sides and yada, 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 be outside. Well, that really hasn't slowed down this year. And yes, you just said I was just traveling, but I just had the opportunity to take one of the 1000cc Polaris Razors out in the mountains.
And you want one now.
And I want one now. That's a hoot. So I can see the appeal. So that's one. And then the other side of the consumer coin is Home Depot. I think that them and Lowe's, I guess for that matter, but I'm not picking Lowe's, should just continue to do well in a low-rate environment where people want to spend money and fix up their homes. Construction's hot. Everything's hot. They should be able to pass on the inflation to the consumer. I think that that's a good place to be.
Okay. I'm going to give you two this time because they go together. They're called the local play. So I have Marathon Petroleum, which has been beat. Energy in general has beat down. It's had a comeback, but they're still room to go, and they're on the distribution side and the marketing side where I think they're still, less volatile and less reliant on oil prices, which are, again, in mid up to 60s. So they're not so worried about that staying there. They're worried about the supply, and more people travel, more people will go that route. So Marathon Petroleum, and then Goodyear Tire. They just finished their merger with Cooper Tire.
Yep.
And so I have them in my portfolio there, as well as just two local.
Local man.
Local.
You're a local guy. I have a couple, I'm going to say, very speculative holdings, and I'm not generally a fan of Wall Street bets and things that are going on around that area of the market.
You're going to throw it in there.
But I actually found two heavily shorted stocks. Now, these are stocks that hedge funds and such institutions have taken large bets that they're going to go down. That's essentially what a heavily shorted stock is. And these Wall Street bets people and traders love these stocks, and they just bid them up to try and toast the hedge funds, right?
Stick it to the man.
Same thing that happened with GameStop. Mm-hmm. So anyway, two companies that actually have not yet had a big run-up, however, are heavily shorted. One of them is C3AI. It's a tech company.
That's one of the Star Wars?
Yeah, C3AI. It's a heavily shorted software company. It went public in December. Lots of short interest in that. Hasn't had a big run. Think that could be a Wall Street bet target. We'll see about that. Another one is... My numbers are so small on here. Clovis Oncology. It's a heavily shorted biotech that focuses on cancer treatments. So also wondering if that will get some interest there. So those are some of my, they're not going to be big positions, but they're my what ifs. And hey, I could really hit a home run with some of these.
100,000 hypothetical money. It's not a bad risk.
Now again, those are another example of, I wouldn't buy this for, these are not long-term positions, people.
Nope.
Hypothetical money here.
And you probably even would be hesitant if our rules were you pick 10 and stay, that you wouldn't even take that, because your ability to get out of them when you need to is the key to those.
I can do that now.
Yep. And you don't have to worry about volume because you're not really trading.
I'm not going to move the market either, too. Yeah, exactly.
All right. Those are good. So I got a couple here, but I'm going to go with another one where it plays off of your emerging market theme, and so that it's Alibaba.
Yeah.
And so they're kind of the Amazon of China.
Yeah, exactly.
And so people use that for a lot of transactions. It's recently been down in value and dropped in price a little bit, and so I think now is a good time to hold it, and that's kind of part of my kind of international or emerging market play.
Yep. Next up for me is Disney. It's hard to bet against the House of Mouse.
That's right.
I think that just like my travel theme says, people are going to be flocking to Disney on both ends of the coast, especially once California continues to reopen. But Florida's pretty much...
They just launched a new Marvel...
I heard that.
...themed
sounds fun.
Part of the
awesome.
resort in California.
But as far as Florida goes, they should be pretty much wide open and just printing money, as well as the fact that I still feel like Disney Plus is going to be even huger than it is now. Loki just launched. That's something, and they're going to be launching those every week. We got more movies and shows coming out, so I'm going with the House of Mouse.
Right. I also have Disney on my list, as well as Comcast, which owns Universal, and they own Universal and also the channel which hosts the Olympics this year. So hoping they get
NBC.
Some good, NBC Universal and NBC, and so all that's going to play into. So I got Disney and Comcast as my two kind of media plays there.
I have Cabot Corp, kind of going off your tire play. Cabot Corp is a materials company that makes really carbon black, which is a component in tire manufacturing. Ask me how I know. I used to work at Cooper. Yeah. So anyway, I think tire demand is going to be hot as people are traveling more, driving more this year. Car purchases, cars need tires. Everything's good, I think, on that front. So that's Cabot. A couple quote-unquote technology companies. One of them, I don't know why it's technically a tech company, but it is. NVIDIA, I think they make the best graphics cards in the world. Autonomous vehicles, gaming, mining of cryptocurrency, these sort of things. Data centers are huge for them. I really think that it goes higher from here. ADP is my other tech pick. So that's automatic data processing. Now that is a payroll service provider. You may get paid from your employer that way. But what they do is they obviously make money. Essentially, a lot of how they make their money is on the float of the money that companies give them to then pay. Well, they make money on the interest earned in between that. Well, as interest rates rise, which I kind of feel like interest rates are going to continue to rise as inflation is rising, their float's going to be better. So I think that's good. As well as we have an extremely hot and tight labor market that's only getting better. So I think that that's going to be a tailwind for them as well.
Yeah, and that float that you talked about, I believe they require the employers to, let's say you get paid on the 15th. They require it on like the 10th early on. And so they guarantee themselves a certain amount of this float, this carry interest that they're always locking in. And then they have all those additional services they're always trying to sell you that add on the additional profit. Good choice. One of the ones I'm doing, and this is a play on the opening back up of everything, is Nike. And so, as people are getting out being more active, they're going to participate in that, the sportswear, the shoes, everything, as well as, don't know if you know this, but they've started releasing some Space Jam 2 stuff as well.
What?
So, like shoes, because LeBron is his endorsements and stuff with Nike, and so some of the Space Jam stuff.
When's that movie coming out?
Sometime this year, I believe.
I'm ready.
So Nike is another one I'm doing a play on, more the athletic and outdoorness.
So Nike, you didn't know if you knew this, but Nike owns Converse now. and they have for a while. I just got an email or something, and Converse is launching, like, they look kind of Converse-y, but they're kind of Nike-y with the knit, tight-fitting, like, don't really need to tie your shoe look. Chucks.
They look good?
They look sweet. I kind of want some. That's the dad shoe of the world right there.
New Balances. White New Balance.
Nope, I can't do it. Banking on banking is my next theme. So I'm going to take a position in Bank of America. I just think that's a well-diversified, large bank, should do well in rising rates. I'm going to take a position in Berkshire Hathaway, technically a financial, lots of insurance operations. Also, their investment portfolio is well-diversified.
They have somebody... Who's that guy? What's his name?
Buffett?
Buffett. Yeah, that's his name. Yeah.
Well,
the young guy, right?
The young guy. So Buffett did name his successor.
Yep.
I also think that took some uncertainty off the table there. And they mentioned that in their last earnings call that they are receiving price increases, but they're also passing them on. And I like the company that's able to pass on price increases. So inflation shouldn't impact it as bad. My last financial is, and I did this last year, and it doesn't always pay off, but I'm taking a position in Market Access Holdings, and that is an electronic bond trading platform, one of the largest in the world. If you didn't know, bonds are actually a lot larger of a portion of the entire market in the world than equities even. So I think there's a lot of potential there. It's a volatile stock, but it's down like 24% year to date, and I think it's got to, at 52-week lows, it's got to go up from here. So I think that's a good play for me.
There you go. So one of the other ones, and this is similar to your car rentals, is I have CarMax.
Yeah.
And so they're the largest used car dealership in the U.S., and I think there's going to be a lot of trading and moving of cars over time, and I think they will participate in that.
Cisco. There's two Ciscos.
There is. Which one are you?
I'm talking food Cisco.
Food.
SYSCO. Cisco. And that one is a position I will be taking to get on the restaurant reopening. Restaurants are going to be reopening. Cisco provides restaurants with all of their food, and I think that they'll also do a really good job at protecting their margins from the inflation impact and passing those along to consumers, which are then going to be passed on along to the ultimate restaurateurs. So, yeah, I think that that's a good play there. My energy pick is Magellan Midstream Partners, another one I had last year, but I really think that midstream area of the energy market is going to be least impacted by fluctuating oil prices, but also with pipeline plans being shut down, the ones that are in place are really going to be in demand.
Yep.
So like you, I'm picking something in the middle. I like that is there.
They have a nice dividend yield, too.
They have a nice dividend yield.
All right. I'm going to go with underwear. Hanes brand.
Hanes brand.
And that's a
Michael
play.
Jordan.
That's a play on the kind of staple side of things, the more value.
Oh, they're a staple.
They are. You got to have them. And and I think they're a little bit undervalued, and so there's a good spot there. And they're one of those, again, value oriented. They're always around. They're stable, and so there's a play on that side of things.
How many more do you have, Josh?
I think I have 3 more.
Oh wow, I only have one. I've gone through them quick.
Okay. Well, my two kind of go together. So
go for it.
All right, so these fall into your bucket of kind of other, and so I kind of save those for last. I'm also going to do the Ethereum Trust Grayscale, ETCG is the ticker on that one. Between the two...
ETHE.
Whatever it is.
Yeah.
Or I thought it was ETCG. It doesn't matter. I wrote it down wrong probably. But it's the Ethereum Trust, and that, like you said, is just a play on the digital currency, cryptocurrency. Between the two, I picked Ethereum. I don't know.
Hey.
And that's how much thought goes into these sometimes for me. And the second one is VEU, which is the All World ex-US. It's an iShares, and that is everything but the United States.
Yep.
So again, I have a lot of U.S. holdings here, but I wanted some international because, like you mentioned, there's a lot of undervalue out of the U.S. The U.S. is a little overvalued compared to the rest of the world, and so to capture a little bit of that play, I'm going to have some weighting in the ex-U.S. All-World Index.
Awesome. Well, is that it for you?
I got one more.
Okay, we'll wrap up with you. My last pick is Merck. So Merck is a healthcare company that just spun off kind of the old school legacy portion of their business in a company called Organon. And what's left should be a more growth-focused, innovation-focused healthcare company. They're also not doing so great year to date, and that's okay because I think that they should be able to pick up now that they're more growth oriented. Their cancer treatment product Keytruda is kind of state of the art, and I think that should propel them.
All right. And my last one plays off of actually the digital and cryptocurrency. It's Coinbase, which just had their IPO earlier this year. It's down about a third from where it IPO'd, like 30 to 40% down. So I just think, again, as cryptocurrency, they're kind of the known holder of cryptocurrency, and they're now publicly traded. So my play in on that is that I think there's a lot upside, at least to get back to their initial price, maybe. But that's where I'm going with my last holding, my last pick.
So everyone, as you could see and hear, we have very different approaches to how we're thinking about this. There are some common themes, a lot of common themes around, I think cryptocurrency is a common theme. It's obviously real now. It's becoming more and more prevalent, even in normal financial discussions. Themes around travel and reopening, very, very common, as well as, just what we expect things to look like in the economy going forward. So that's kind of where we're at. We're going to post at least the names of our holdings in a list form in our show notes or something like that, so you can see. We are going to have various weightings associated with them when we buy them in the portfolio, and you'll be able to see those when you log in and see it as well.
We'll be able to see each other's and how
exactly.
Are going.
So the question then is,
first,
Josh, what is the dad joke of the week?
Let's do a dad joke.
That's the question.
All right. This is informational. In Hawaii, you're not allowed to laugh really loud. You know this, Austin, don't you?
I know this one.
Yep. It's just aloha.
Just aloha.
Just aloha.
That's classic.
I love that one.
But the real question is,
how do you sign up for
this? How do you sign up for this? So first of all, in the email that we sent out this morning, in the Facebook post we're putting up today, maybe a tweet, maybe an Instagram post, all of the social medias, or in the show notes below, or on our website, you will be able to click a link that goes directly to the group that this will be hosted in on Investopedia. So do that, create your account. You'll just need an email and a password just like normal, and then every time you log in, it'll have your stuff saved, and you'll be able to see everything and compete with us and check where everyone's at all the time. The password, there's a password. This is a private group. The password is, it's all lowercase. Donut. D-O-N-U-T. Donut. That is the password, so remember that.
You only need to know it the once. Just to join the group. That's it.
Ideally, get your picks in on 6:30. So this is starting on 6:30 because it runs, this competition, 6:30 to 12:31. You cannot, because I tried to test it out, you cannot put anything in early and then have it hit. Nope. 6:30 is it.
Trade it on the 30th.
Exactly.
Or
so
later.
June 30th or later.
I'm going to dollar cost average in.
You've got $100,000. You're just going to divide
average in
it up
for the next 6 months.
Email us at hello@theinvesteddads.com when you have loaded your portfolio. We would love to know who is competing with us in this, and then we can kind of talk to each other as this is going on. And if Josh has a really good day or a really bad day, we can give him some crap. That's kind of how it's going to go. So we're super excited about this. I think this is a step in the right direction towards engaging with you awesome listeners who, listen to us week in and week out. This is just a fun way to kind of have some good banter going on.
Yeah, it was fun for us last year, and we thought, boy, it would be great if we had some more people to participate in this, because just Austin and I, depending on the day, who knew what was going to happen. But now there's a lot of people and some more flexibility. It'll be fun to see what your guys' ideas are and themes are and how you guys are trading as well.
And if you like this, the way that this works, it's very easy to replicate this year over year over year over year. So hopefully in 10 years, we'll be having the 11th annual, the official second half Stock Draft Invested Dads. I don't know. The long description. As always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. Investing with fake money doesn't really get you there, so that's not going to be on there. But check it out anyway. It's free on our website. Josh, how can people help us grow this podcast?
Make sure you subscribe. That way you get our most recent episode every week. Leave us a review on Apple Podcasts and email us any ideas, thoughts, questions, or if you have any problems with the whole getting set up on there, shoot us an email at hello@theinvesteddads.com. And make sure if you know anybody that'd be interested in this, again, if it's after 6:30, you can still join. There's not a cutoff. You can join anytime between now or 6:30 and 12:31. So let your family, friends know. Send them this episode. Get them hooked up on the Investopedia page. and we'll see what happens at the end of the year.
Yeah, let's make this thing as big as possible. So anyone at all that you think might be interested, send them our way.
Who knows, there may be a prize at the end of the year.
Thanks, exactly. There's likely to be donuts involved.
Yes, at least donuts, maybe something else.
Exactly.
All right, we will talk to you
Until
later.
next week.
Right,
bye.
bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.